This episode is brought to you by Tegus, the future of investment research. If you follow my newsletters, you know that Tegus is one of the things I use most often. Almost every post I have has some clip from an expert call or some quote from a management transcript that I've got off BMSEC that, it's because of Tegus that I've got access to all of that. It's revolutionized how I get up to speed on new industries and companies. I've been a happy subscriber of it for over 3 years now. And I tell you, I use probably every day I'm logging on to Tegus to look at an expert call transcript. And I certainly know, my BMSEC, I'm glad that it's unlimited because I am looking at BMSEC all the time. I'm looking at my Google Chrome right now and I have 30 tabs open and I'd say 18 of them are from BMSEC. So between Tegus and BMSEC, I am a very devoted user here. Look, it's one platform where you can dive into expert call transcripts, management checks, panel calls, and detailed financial data. No more fragmented data sources or endless searching. Tegus brings everything together, giving you a crystal clear view of the industries and companies that matter most. If you're ready to supercharge your research, visit tegus.com/value. That's tegus.com/value. Trust me, once you've experienced Tegus, you won't go back to your old way of doing research. All right, hello, and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have on from Clayton Partners, Jason and Brian. Jason, Brian, how's it going, guys?
Good. How are you?
Doing good. Look, really appreciate you guys coming on the podcast. Really looking forward to it. Before we get into it, I just want to remind everyone, start the podcast the way I do every podcast. Nothing on this podcast is investing advice. That's always true, but particularly true today. We're going to be talking about a Canadian domiciled company, Mattr Corp, just to throw it out before we get there. But, people should remember Canadian domiciled, it carries a little bit of extra risk, extra tax advices, extra tax consequences. Nothing on this podcast is investing advice, not tax advice, anything like that. So please consult a financial advisor, do your own work. All that out the way, Jason, Brian, really excited for the podcast today. I guess I'll just start. What is Mattr Corp and why they're so interesting?
Yeah, I'll let you kick it off, Brian.
Yeah, sure. Mattr Corp is a kind of recently restructured company. The remaining businesses are sort of materials technology. They've got a composite technologies business, which makes spoolable composite pipe, as well as composite underground storage tanks. And then one of the, real interesting growth aspects of that business is stormwater management systems. So composite systems to handle a lot of the, the sort of incremental demand for dealing with stormwater, wastewater, et cetera. And then the other side of their business is called connection technologies. And that's really electrification focused specialty wire cable and some heat shrink solutions. Goes into, automotive. There's a really good trends there with regard to EVs and hybrids, as well as nuclear applications, aerospace, and then just kind of general industrial. So pretty highly engineered wiring cable assemblies and related products. Those are the remaining businesses. I think what's made it a really interesting company to us is that they've gone through a pretty significant restructuring. They sold highly cyclical pipe coating business that was basically, servicing deep water construction projects. So obviously you can imagine a hyper cyclical business. They recently sold that. They've got a pretty compelling, robust balance sheet, can probably put $300 or $400 million to work. And so we feel like they're just on really good footing going forward as they redeploy those proceeds and grow the remaining businesses. And you get all that with a really, really solid management team and a good runway for growth.
I think when it was still Shawcor, because this is the old Shawcor, there was a write-up on Value Investors Club that referred to it as a Fort Knox balance sheet, which I always liked, which always tickles me. Jason, did you want to add anything to Brian's overview?
No, I think it's a pretty simple story. It's trying to get out of the oil and gas services kind of sector. Obviously, they still have some in the composite pipe, but the balance of the business is growing and has some secular trends we can get into that we think are pretty attractive and shouldn't make it trade like a deep cyclical business that it used to be. And it's sort of stuck in the SIC codes of its past.
It's one of my favorite things where one of my favorite investors was Bob Evans, which used to be, for a while, it used to be a restaurant company, and they sold the restaurant and they became just it was processed potatoes, branded potatoes, basically, that they were selling to grocery stores, which is about as non-cyclical and non-restaurant as you could get. But it was still in the SIC code with restaurants. Yep. Only restaurant analysts covered it. And it was like, hey, this isn't a restaurant anymore, but people thought it was. I guess backing up from SIC code mismanagement, one way I'm trying to just like lead every pod and frame every podcast discussion going forward is the market is a competitive place, right? There's a lot of smart people out there doing research, everything. When you guys look at Mattr Corp, what do you think you're seeing that the market is kind of missing that's going to lead to alpha generation here?
Yeah, I think what we've been, knocking on wood, what we've been pretty good at over the years is judging management teams and sort of their decision making. And I'm not sure, on the face of it, if you just start, reading the MD&A and the documents, if you can really appreciate the sort of the private equity approach that Mike and Tom are taking to the business and some of the underlying growth that's happened in the connections business, notwithstanding some inventory changes up in Canada. So there's, I think, really the judgment of management and their ability to grow this and the decision making around capital allocation, I think, is probably a differentiator. I don't know, Brian.
Yeah, I think that's probably the biggest one that we see that we think is compelling. And I think just the general quality of the remaining businesses, and there's just been so much noise and confusion through this transition and selling off. They still have a small remaining non-core business in that space that they'll be also selling, but just the numbers have been really noisy. So I think that's part of it. Also, kind of to your point, the fact that it's a Canadian listed stock, yet the vast majority of their businesses are US focused, and it's really a high quality small cap that I just don't think anybody is really focused on. And also, to your other point, with the coming from this sort of oil services space, that's sort of who their analysts are. I think they definitely are looking forward to more sort of multi-industrial coverage. And I just think over time it becomes a little bit more mainstream as far as who they are and what they're doing. They're also looking pretty intently right now for an acquisition in their connection business in the wire and cable space. They think they have a lot of opportunity to penetrate, US based accounts in that business, and an acquisition would help them along that path. So yeah, I just think a lot of reasons why it would be either one, not focused on, or two, just sort of misunderstood. And the balance sheet is pretty robust for a little, industrial business. They've got a lot of capital to deploy, and they've already been doing that. The minute they closed the deal, they started pretty aggressively buying back stock, which we thought was them putting their money where their mouth is. We think they'll continue to do that even while being able to do a reasonably sized acquisition. And we trust their underwriting and their capital allocation. Like, they're not going to do a deal unless it makes really good sense for the strategic fit, but also them getting really, really good returns on that capital.
Yeah. And Andrew, one of the other things, like, I had a conversation with another investor who said, it's really illiquid. So if you look at the US listed, over the counter name, it looks like it trades about 1,000 shares a day.
Yep.
Whereas that QSIP is interchangeable with the Canadian. So you can actually put up 100,000, 200,000 shares, and broker will arb that for you. So you can own it in U.S. currency if you want. You can obviously buy it on the TSX, but it's very liquid on the TSX. It's just, sometimes it's just going the extra, picking up the phone and finding out, oh no, we can actually buy hundreds of thousands of shares if we want in the U.S. QSIP. We just have to actually pick up the phone and talk to somebody about it. So yeah, there's a ton of smart people out there, but not everybody goes the extra call to figure out what they can do actually.
No, look, it's one of the most interesting things out there. Like this is Canadian domiciled. I think there are London domiciled companies too, where a lot of their business is in the US. And, I'm always a little skeptical when someone comes to me and says, hey, this trades at a 4 turns discount because it's in Canada or because it's in London. But, all with a lot of the business in the US, and you kind of do see that. I'll just ask that. Do you guys think they switch to a US listing at some point? Because a lot of their business is in the US, and it does seem like that would kind of help. That would kind of help juice liquidity, juice visibility, juice the multiple at some point.
I think at some point we've discussed it with them. I actually like IFRS better, and you kind of started the pod with the caveat of it's Canadian and there are tax issues and questions. But in some context, the MD&A and the information that actually comes out of IFRS in Canada, I think is better. And more descriptive of what's going on than some of the U.S. disclosure GAAP personally. But yeah, I think over time they feel like they need to grow and get a little bit bigger and to sort of absorb the cost. And obviously Sarbanes-Oxley, you can have your own opinion about it, but it's a joke and it costs a lot of money, and they would have to do a lot of stuff. And these are old businesses that, the Shaw businesses were, 80, 100 years. I mean, these are old businesses. So I think there would be a lot of work and cost that, maybe if they're double their size in 3 to 5 years, they might want to take on and for a U.S. listing. But otherwise, they're focused on growing and compounding capital currently.
Jason, look, I'm sure this is the question that everyone dreams of when they're listening to a podcast hearing answered. But you mentioned you like some of the disclosures better in IFRS than GAAP. And I can go both ways. Like, I'm no accounting expert, but obviously I look at companies in both. What are some of the things you like better in IFRS than GAAP?
Well, they show their lease obligations as debt, basically. And I just find the MD&A, the discussion of the actual businesses, to be more descriptive. I find the IFRS has much. GAAP can tend to be very rule based, such that people game the actual rule, sort of form over substance. And IFRS comes back in a lot of places. IFRS says, hey, the substance is what matters. And you actually have to disclose what's going on, even if you hit this particular bright line test. If you're really doing something different, but you hit the bright line test, you need to actually capitalize it or not. And it just seems to be I've done a lot of deals around GAAP in my prior career, and I trust it less, I guess.
You said the MD&A is more descriptive in IFRS than in GAAP, and I just, is that a function of Mattr's MD&A is more description than your average U.S. company, or do you think just you get better descriptions in IFRS than GAAP overall? Because I read a lot of 10Ks, and sometimes I read one, I'm like, I'm not, especially the first 3 pages, which is like the business description. Sometimes I'll read it and I'll be like, I don't know what the hell this company does. Like, did I just read something? Like, I'm completely confused. And sometimes I'll be like, oh, that was a really interesting overview of strategy and everything. And I've always thought, to me, it was more the company and at the company's description than some type of GAAP rule. But I'm curious, do you think IFRS just encourages it and allows more free flow, or do you think it's just this company specific?
Or maybe I have a subset of the actual companies that I've invested. Maybe it's a selection bias. The companies we've invested in Canada have had more descriptive. I haven't gone and done an exhaustive search of all Canadian MD&As and
No,
so some sort of analysis to know the difference. Yeah.
You just said it, and I can be a accounting finance nerd, so I thought I'd go there. Again, I'm sure it's what everyone loves. Let me back up a little bit. So Mattr Corp, you guys mentioned, kind of more industrial industries. They're looking to do acquisitions, Canadian domiciled. I think the first thing, and actually, Jason, I think you emailed me. I had someone on pitching TerraVest earlier this year. And when I started looking at this company, I just kept having like little rhymes back to the TerraVest story. And, that TerraVest has been outstanding. It's a 3x over the past past year. It's executed great. Ignore the execution of the share price, but I just guess if I said, "Hey, this rhymes with TerraVest," like how would you guys respond to the positives, the negatives, that comparison?
Well, it's a lot cheaper, and you're at the starting line of TerraVest. So go back 10 years. I mean, I'm not an expert on TerraVest. We've known some of the former directors and investors there and have a lot of respect for what they're doing, but it's not a sexy business. This is, the stuff at Mattr is not some sort of, crazy sexy business. And I think TerraVest has won by executing, basically, and earning a reputation of compounding capital, buying back stock when it's appropriate, and doing it aggressively. So, not being an expert on TerraVest, just seeing things that rhyme, like you're saying, it's like basically you're at the beginning. They finally sold this last big asset at the end of last year, and like Brian said, things have been a little bit noisy with some slippage in permitting in their tank business, and they thought they had a big order recently. I think you asked about the quarter a little bit, but they thought they had a big international order on the pipe business, which was going to make Q3 kind of grow nicely. And we thought we were sort of off to the races here, and they got that order pulled. So you're basically at the beginning, the starting point of something that we think hopefully looks like TerraVest and ends up getting, a multiple similar and returns. Looking out the front of the window.
This episode is brought to you by Tegus, the future of investment research. Look, if you've been reading my newsletters, you know how often I rely on Tegus for my research. I probably read 1 or 2 expert calls a day, probably average 7 a week off of Tegus. They've got the largest transcript library in the world with over 75% of the private market transcripts. Whether you're curious about AI, biotech, or any niche market, Tegus has the insights you need. What sets Tegus apart is its all-in-one platform. It's packed with expert call transcripts, management checks, panel calls, and in-depth financial data. No more jumping between different services or piecing together fragmented data. With Tegus, everything is right at your fingertips. The best part? The insights you get are from the very people shaping the industries you're interested in. You'll find perspective from insiders and executives that you can't get anywhere else. To see Tegus in action and understand why it's one of my go-to resources, visit tegus.com/value. That's TEGUS.com/value. Trust me, once you try Tegus, you'll never look back. No, that's great. Brian, let me turn this question to you. So one of the things, and sorry to keep bringing TerraVest up as the comp, but when I looked at TerraVest, one of the things I kept saying is, they're making big tanks for outside gas station stuff. And I kept saying, hey, how can this be a good business, right? It just seems to me that should be a cost of capital business, right? A mom and pop can do it. You're basically taking a lot of metal and turning it. And obviously they've found a lot of different areas that have given them really nice returns on invested capital. They've been able to acquire really accretively. When I look at Mattr, one of the reasons TerraVest popped up is the same thing kind of pops to my mind, right? Like I'm looking at their investor deck right now. Is it Xerxes? Xerxes? There's 2 X's in there, which is tough to pronounce. But, underground storage tanks and treatment solutions, flex pipe, premium spoolable compositive pipe, Shawflex, engaged wire, cable, and assemblies. Like I look at all those and I say, oh, my first thought is cost of capital business. But what you guys are saying is A, low multiple, right, which is always helpful. But B, you're talking about growth. You're talking about accretive, value enhancing growth. So Brian, I want to ask you, like, what's the secret sauce here that makes my initial take, oh, pipes are a commodity business? What's the secret sauce that makes that wrong?
Yeah, I mean, I think it's obviously a little bit different answer in each one of the businesses, but it's highly engineered composite products. It's not steel tanks or welded steel pipe. that it's composite solutions that obviously have to be engineered for whatever the application is. So, you know, in the pipe business, it's highly engineered composites that can handle really high pressures, really high temperatures, things like that. And so in that business, they're taking a lot of share from welded steel pipe. There's a lot of opportunities that they can use their application for that never used to think about composite as a solution. And then more importantly, they've been spending the R&D dollars to engineer the larger and larger diameters of pipe that can meet all those tests and be, a solution for the larger diameter pipe applications. So that's one of the reasons that business has such compelling growth, is that they're going into bigger and bigger chunks of that addressable market with their composite. On the tank side, it's a similar story. There's just not enough highly engineered composite tanks for the level of demand out there. So a lot, we've heard a lot of stories of customers basically going with steel because they can't get composite. There's obviously applications where maybe that makes sense because you don't really need to focus or worry about how long the tank lasts and sort of the maintenance of it. But most new applications would much rather have composite, and that's been benefiting Xerxes. They're also shifting to much larger tank, just the pure size of the tank, and that is incremental engineering. Not everybody can do that. That's an area where Xerxes has been adding capacity as well. So I think the tank business is one of the pieces that is a bit misunderstood. There's a significant wave of demand in fuel tanks with all these new travel centers and new sort of bulked up convenience stores that are being built to effectively replace a lot of the, 50, 60, 100-year-old fuel stations. So while everybody's focused on electrification, at the same time, we all know there's going to be fuel in vehicles for a very long time. And that footprint of stations, especially large format travel centers, is growing rapidly. So that's, and then obviously there's other drivers to that business on the stormwater management side and just pure sort of liquid storage underground. All of that stuff, drives that business.
Brian, could I just pause you there for 1 second? On both of those businesses, you mentioned highly engineered composite is taking share from steel. If I have to kind of like sum it down to one word, which is awesome for them, right? But I just want to, for my own edification, I think for listeners too who are trying to understand this, is the advantage here, they are playing the highly composite, right? They are benefiting from that share shift. But is the advantage that they can produce the composite? So there's some really unique process and technology and everything around producing the composite? Or is the advantage in the highly engineered, where they've got the engineers? So, maybe the composite is more commodity, like you can find composite somewhere, but they've got the engineers, they've got the know-how, they've got the skill. And, as you get more and more technical, I think about something like in the Sphere in Las Vegas, completely different business. But I think they said there were 2 firms in the world that could design something like that. So, those 2 firms are probably earning pretty good returns on capital if they've got all the know-how. So again, I rambled a little bit, but I'm really just trying to understand because look, TerraVest was a 3X, and I'm not saying this is the next TerraVest. I'm not saying it isn't the next TerraVest, but I'm trying to understand. So, because if it is, I know you guys think it is, or it can generate those returns. I kind of want to be able to swing at that if it is. Does that make sense?
Yeah, I mean, I think it's all of the above. I think it's much more the fact that you have the right solutions, the right engineering, the right customer support. You're deeply embedded in those markets, and you have. You are in sort of the pole position with the really meaningful customers. I'm not about to sit here and tell you that somebody else couldn't come up with a composite tank if they set their sights on it. I think they absolutely can, but it's more just a function of what's the capacity out there. Who are the players that have the approvals, that basically have the products that can meet the spec for these development projects.
Right. I mean, TerraVest is
it's really more
TerraVest.
And the pipe business is no different. I mean, it takes a long time to get a product out there that's approved and can handle the situation that you're installing it into. So, I'm not about to say that you can't get more competition, because we all know you can always get more competition. So I just think, they've sort of proven over these last number of years that these businesses are north of 20% sort of EBITDA margin businesses. And with the investments they're making in their manufacturing footprint, they think that margin can continue to move higher as we come out of these investments. That's another reason why I think the stock is a bit misunderstood, is they're in the middle of investing a ton of capital for you to enable a significant growth path, but also drive efficiency and margin improvement.
But they have competitors. Yeah, they have competitors in all their businesses. So, I mean, just like TerraVest, if you look at what they do, it looks like a cost of capital business, as you said. But I think Brian summed it up really well. It's the permits. They have a brand. People respect it. They execute and deliver for their customers pretty much in all the segments. Some of the wiring stuff, I had the same impression as you before we visited one of the facilities, and they have where they put connections together. They literally have their ovens, at the facilities for the auto manufacturers. So could somebody else do it? Of course. Do they have engineers that are irreplaceable? Probably not. But they have good brands, they have good products, and they have good service. And so, I think that's the answer. There's nothing that's irreplaceable, like the sphere type of example.
Could I just dig in? I did not realize that on the ovens at the auto manufacturers. Could you just talk a little bit more? Because I'll just tell you the analogy I'm thinking in my head. Something like air products, right? Where they've literally got their things that are piping gas directly to the hospital, and they've got the pipes. It's like, could someone replace that? Theoretically, yes, somebody could build a new facility, get all the, air products. A lot of what they make is actually regulated, compressed gases and everything. Theoretically, someone could build a facility, take a pipe, put it into the hospital. Absolutely. But that's going to be a lot of effort. Now, that might be a little bit extreme comparing to ovens at an auto manufacturing plant, but I'd love to hear, like, in that example, what are they ovening at the auto manufacturing plant? Like, how long has that relationship been going on? How does that look?
Yeah, I can let Brian, you can chime in, but it's basically connecting, a way to connect two different wires, and then do it in a way that deals with heat and water, and basically you can't get it wrong, right? So it's a cheap product. It's one of these things you like to see, which is it's not you basically put a wrapper around the two things, and then you use heat and to seal them, basically, and connect them. And so the Connection Technologies division does that, and they provide basically the oven that connects the wires, and the sleeve, so the composite that does it. And it's very simple thing. It reminds me of, like, you remember Simpson strong ties, right? Like the building products, where it's not a very expensive piece, but if you get it wrong, the car stalls out and shorts out. And so they're pretty much in, Brian, I think they're pretty much in every auto manufacturer, or like 80% of them. And the relationships have been, are very, very long and deep.
And so those are pretty much sole source, you're saying? Like, there's no one else who can make those for those 80%?
What do you mean sole source? They're in the majority of the auto manufacturers. Certainly they have competition, but in where their ovens are at, I don't think you go buy somebody else's sleeve. That was for sure. Yeah.
That was exactly the question. Brian, did you want to add anything to that?
No, I was just going to clarify that's a heat shrink product. So it's not the actual wire. It's insulating the connection of the two wires and sealing it. And so again, you're getting into sort of the engineering part of it, but that's a highly engineered solution. It's sort of the interplay of the composites in that heat shrink tubing, and then how you bond it to the wires. So you can't say, oh yeah, I'll just use this other guy's solution. It's all engineered together. The the way you apply it and the product itself. So
Fantastic.
pretty sticky, obviously, once you're designed in.
I think it was on the Q2 earnings call. It might have been somewhere else I was reading, but they're pretty explicit. Their goal is to double revenues by 2030 and grow EBITDA margins to greater than 20%. I mean, right now you're buying them at 5 or 6 times EBITDA multiple, something around there. You run the numbers on doubling their revenue while taking EBITDA margins from kind of the mid-teens currently to over 20%, and you start looking at that's a lot of earnings, right? So I wanted to ask you guys, there's 2 pieces to that. A, we're going to double our revenue, and B, we're going to almost double our EBITDA margins. Let's be generous and call it that. How do they do that, right? What does it take to get there? How much is organic? How much is inorganic? How do they kind of drive that?
I think the first thing to say there is that that's their organic targets. That has nothing to do with M&A, which would be obviously pretty significantly incremental.
Okay. I wasn't clear. I kind of thought that they were building in a little bit of inorganic when they mentioned that.
Yeah, I mean they say it pretty explicitly that those are their organic targets. But yeah, I mean that's the runway they see in their existing businesses. That's why they're investing, to modernize their manufacturing footprint. And obviously that's over 7 or 8 years. It's not like they're going to double in the next, year or two. But I think they see a very solid, line of sight to sort of 10+% annual growth. That's kind of what gets you to a 7-year double. And, on the margin side, I mean, they have made good headway the last number of years. It's just when you take it all the way down to the bottom line, when you're totally out of these businesses that they got rid of, and then carrying kind of the proper overhead for the remaining businesses, I think that lands you sort of in the, 16, 17-ish now. And I think they believe that they can drive that higher, mainly through efficiency and just, higher volumes through a more modernized manufacturing footprint.
Yeah, they have 4 new manufacturing facilities coming out of the ground. I mean, 2 just came out and are producing and getting more efficient by the quarter, and another one will open by year end, and then 1 in Q1. So yeah. they've invested Brian, almost roughly $3 a share Canadian in new property, plant, and equipment. So that organic growth, has to pay off. The returns that they're expecting from that, obviously, that's a big part of the thesis.
Yeah, and I think that's that's part of, again, the opportunity, the current sort of wobbling around in the stock. I mean, they're absorbing some pretty significant expenses. It's not all CapEx. They've got a pretty significant chunk that's rolling through the P&L as well. So it makes the reported numbers look pretty ugly right now. Now, of course, if you follow the story closely, you understand the pieces that are sort of pertaining specifically to these investments. They're going to roll through that really kind of Q1 of next year. You'll sort of be past all that. But the underlying profitability of the 2 segments, backing out those costs, is very similar to the last year or so. It moves around, quarterly based on volumes, but I think that's one of the other confusing things about the story. If you're looking at it as a new investor, the profitability's, pressured this year from all the investments they're making.
Yeah, it runs it through OpEx, sort of the payments they're making that are operating expenses, they don't get to capitalize.
One of my favorite stories is always, it's a little overplayed, but I do love whenever somebody says, hey, they're investing through the income statement. Like, I do think that is, especially if you think the investments are going to be very high return on capital. Let me lob another higher level question at you guys. How much of this is for you is a bet on the businesses, right? We've talked about the composite, taking share from steel. We've talked about some of the things where they might be really pretty baked into the process. How much is this a bet on the business? Great balance sheet, all that, versus a bet on a jockey, the management team. It seems like you guys like the management team, think they can drive growth here. Wouldn't mind if they did some inorganic activity. We can talk about share buybacks in a second, but if somebody's coming and saying, hey, I really like Mattr, I want to do more diligence on them, how much are they thinking business versus I need to get comfortable with this management team?
I mean, Jason can chime in, but I think it's always both. I think our investment style focuses intently on management and capital allocation and, them proving to us and over time that they think like owners and that they make smart investments when they've fully vetted the opportunity and they understand that they can earn a compelling return on capital. But look, you got to believe the businesses are compelling too. We do. We think they're in a very interesting position with kind of these niche materials technology businesses. But I think we also love the fact that we're confident that if they could get a really full price for one of their businesses that they think is can be sort of positioned or up, they can take that capital and do something even more compelling, we think they'll do it. So that's, those are really just the way we look at it. Those are sort of free call options that you have somebody that is opportunistic and thinking like an owner. If you really look at it, that's what they just did. They just sold their pipe coating business, which is in a massive upswing. It's generating enormous amounts of cash flow right now. And they sold the business because they know that it's hyper cyclical and full cycle. It's not a great business to be in. They want to be in more consistent, more organic growth oriented, lower capital intensity businesses. And that's what they've done. So I think it's both.
Yeah, it's always both. We like and trust the management. I think our second level of work was really on the businesses. And after digging more into, what's going on at these service stations, I just didn't realize the organic growth that's really going on at Buc-ee's and Quick Trip and Racetrack. And there's big family-owned, businesses and private equity-owned businesses that are rolling these things out. And I was on a road trip and leaving Nashville, and a friend of ours said, "Oh man, you got to stop at Buc-ee's on the way out of town." And I'd never been to Buc-ee's. Well, it's clean, awesome, and had a colleague that knew the founders, and we started digging in, and we're like, "Wow, this is actually these people are opening up these very, very profitable businesses." And they're basically rebuilding a lot of these service centers. And then obviously Berkshire owns Pilot.
I was going to say the Berkshire, and I think they're investing a lot of capital to grow that thing. And when I heard Berkshire was buying Pilot, I was like, gas stations, like, isn't that a low margin? But hey, low margin, go look at Murphy's USA, and that's like the worst of the gas stations. What you think? Go look at that stock. I mean, that's what 100 bagger since it's spun, but yeah. You do gas stations right, you do them at scale, and they've proven to be a very good business, and it might be where the puck is going. So that makes total sense. I'm sorry. I was going to say Berkshire too, and I was excited you said it. I cut you off.
No, that's it. Just, I think the team, we early on, we found out they were not net exercising their stock options, which is basically buying stock. You don't see it very often in the marketplace. Everybody usually just net exercises and sells, right?
I did not realize that. That's crazy. Yeah.
Yeah. So that tells you that you have a thinking management team. So the management came, but as Brian said, then the question is, well, does the whole thing just deserve to be a 5 times because it's a cost of capital or whatever terminology you use type of business? And really, is there growth opportunity? And as we dug into all the different businesses, we found that there are growth opportunities. These larger diameter, pipe is actually really, really meaningful to their sales process. And you're seeing it now where, the industry is sort of in decline, and they're able to kind of tread water because they're rolling out new diameters, et cetera. So, probably enough on that. But yeah, we definitely need both the management team and some belief that the business isn't going to, for another Berkshire quote, overcome good management. The bad business is going to win.
This is, I feel a little bit silly saying this, but is there any stealth AI potential here?
Just say AI in the conference call. They're getting some data center love from their water tanks. They're saying that the data centers use a ton of water. And so they're getting a lot of RFPs and quotes for water storage stuff related to these data centers that's kind of growing. So maybe there you could get a little love there.
Yeah, basically to the extent that data center development happens in more dense areas, like, that's when you really need underground tank solutions. So they've said that that's kind of an emerging piece of demand for the hydro chain, sort of water solution stuff. But no, I mean, I think beyond that, I mean, I don't know, maybe somewhere in their manufacturing, processes or something, but I don't think.
So if I'm building out in the middle of nowhere, Texas, storage is not a concern. So I can just take a giant metal bucket and store my water for liquid cooling. So I'm not going to need Mattr there. But if data goes closer to urban and suburban areas where space will be at a premium because land's at a premium, you can't build it, you're going to have to store that water underground. And these guys might be a play there. Am I kind of hearing that correctly?
Yeah.
Yeah. I mean, it's not going to drive the whole business, obviously. So it's a small piece of what they're doing. But yes, that's right.
Yeah, they spoke about it. They sort of laid it out and talked more about the opportunity in detail on their first quarter call for the first time, really. And they just said they've seen, in the last sort of year and a half, they've gone from 0 to basically a pretty significant RFQ volume in that space. It's not really impacting their revenue yet, but the reason it's interesting is it's massive volumes of fluids. So they need the largest tanks they make,
right?
Which again is where there's not much capacity. They're adding capacity with their new investments, and those are very high margin solutions within the tank world.
No, and I asked not because I'm trying to go out and YOLO an AI play, but I've seen it happen several times recently where the AI, it is so much money going into these AI systems. And if there's a component that they deem critical, there's so much money and so much build happening, like you can all of a sudden have really huge demand. The profits can be huge. It can be fast. It can overwhelm the capacity. I mean, you've seen it with some HVAC firms, some engineering firms in Texas and stuff, and they put up huge margins. So while I do feel silly for asking something that at the start I was like, hey, why isn't this just dumb metal pipes or something as an AI play? Like I did want to ask because it's not crazy to think you and I could wake up and say, hey, they had 50% growth 3 years in a row in this thing, and it drove huge margins. Go ahead.
No, I think you're right. You could get some love. Obviously, we're not trying to underwrite that as you mentioned. I mean, it would be nice. And as Brian mentioned, they just added capacity in their larger tank, so that's obviously beneficial.
I think anybody who's watching and listening to this is going to say, all right, Jason and Brian are making interesting points. I'm paying 5 times EBITDA with a great balance sheet, so I've probably got some downside protection unless the world goes to hell in a handbasket. Let's go do some research. And the first thing they're going to say is, oh, well, they're kind of painting this bullish story, 10% annualized growth to 2030, expanding margins, some demand. They mentioned AI demand, and then they're going to look at the stock price for Q2, and they announced Q2. And earnings this stock goes from 17 to 15. And I think Jason mentioned a little bit, they said they had one big pipe project that was delayed. But I do just want to ask, what happened with the Q2 earnings? Why did the stock pull back? How did you guys interpret them? And again, I'm not trying to trade earnings calls, but I think it's something people are naturally going to ask.
Go ahead, Brian.
Yeah, I think my take on it is, when they reported Q1, they talked about a pretty significant uptick in the second quarter, and it didn't happen. And it was basically a significant international order in their pipe business. International is a very rapidly growing piece of their business, so it's been part of the reason why they're growing their composite pipe in the face of pretty significant downturns in drilling and completion activity domestically. And so, obviously the analysts got excited about the fact that you were seeing an inflection in the top line. And frankly, it's even more than that because they had a couple really depressed quarters coming out of last year due to a little bit of an inventory correction on the tank side. And that probably is worth a little discussion as well, because obviously we're sitting here talking about demand for tanks being strong and the good runway for growth. Last year, their major customers had some serious permitting and regulatory challenges. So they're sort of ready with the footprint, they're ready for the tank, but they're waiting on approvals. And so it sort of put a bit of a, stop sign up in that business. The company did not want to build incremental inventory. They wanted to basically hit the brakes on manufacturing to let those permits roll through. That has now happened. That business has swung back up significantly the last quarter or so here, and they're guiding for that to continue through the rest of the year. But that gave you a couple of quarterly hiccups. Now you sort of get another quarterly hiccup on the other side of the composite business. So that's basically what's driving the volatility. The stock's just kind of been gyrating around, between 15 and 18. And I think that's, to your point, I mean, they've got to come out of that with cleaner sort of numbers and cleaner execution as you move into next year. And if you're buying the stock, you're obviously betting that you think that'll happen.
Jason, did you want to add anything there?
Yeah, no, it was basically this quarter. It was Q3, right, Brian? That they had guided to kind of the big bump from this international order.
Yeah, sorry.
Yeah. So just to clarify, it was Q3, and so the analysts had a big step up because they thought they had that, and really they didn't have the purchase order yet. They had the customer come over and look at the facilities and manufacturing plant, and they thought they had the order, but they didn't have the PO, and they probably shouldn't have mentioned it in advance. There's a fine line between wanting to be, as transparent as possible about what's going on in the business, which is great. But then when you get people sort of salivating about it and having, the numbers move around based on what you think is going to happen, you got to really think about when you want to tell people that. And so I think if it was a private equity company, they would have come to the board and said, hey, we think we have this order. This is what it'll look like. But they're a public company. They didn't have the PO yet. And so they got a little bit ahead of themselves.
There's just one more thing from the Q2 call that I was a little confused by. There are some sales on the oil and gas side, I believe, and they mentioned how their product is consumed when wells are completed, not when they drill them. And I was kind of confused, just, as an outsider who does a day of work on this in prep, I was kind of confused by what the issues and what they were driving at there is. Do you want to talk to me about kind of where analysts and them were getting in a misstep on that?
Well, they connect the well to a midstream pipeline, right? So their pipes are not down the hole. So if you can drill a well and leave it capped and not have it producing.
Okay.
Right. So you don't need to connect it to anything until you want to sell the commodity coming out of it. So
they are pro-cyclical in terms of, look, more wells getting drilled is ultimately going to be good for them when they get connected, but maybe not at the time. But if oil and gas prices are going up, more wells get drilled, eventually they have to connect to the midstream to get to market. And that's when they're going to be getting the right. Okay, that makes total sense.
Yeah. The other little nuance there is that, there's sort of an issue in the US where the wells are so significant and there's so much consolidation in the space that you're getting fewer, more massive wells. And then obviously when you get into a period where people are hemming and hawing about oil price, you get a little bit of a slowdown in that completion. They're the takeaway sort of gathering system pipe. And so that's what they're trying to explain is sort of those dynamics, but they're mainly explaining it because they've been growing pretty nicely through all this, partly because of what I was mentioning earlier, that how much they've grown their international business. These international projects are enormous. They're, in the Middle East. That's why they had this they felt like they needed to talk about this piece that was going to be significant in Q3. That's been pushed out, if not pushed out indefinitely. But there's other opportunities, obviously. It's just hard to predict when those are going to show up. But in the US, they've been growing in a pretty ugly environment as far as completions. And they're just trying to point out, like, if that continues, it's going to be hard to significantly grow. But if you get any stabilization or uptick in that, then you have a pretty significant opportunity for them to continue to take share. And you sort of see the more pure benefits of their larger diameter pipe offerings starting to come to market.
This episode is brought to you by Tegus, the future of investment research. Look, if you've been reading my newsletters, you know how often I rely on Tegus for my research. I probably read 1 or 2 expert calls a day, probably average 7 a week off of Tegus. They've got the largest transcript library in the world with over 75% of the private market transcripts. Whether you're curious about AI, biotech, or any niche market, Tegus has the insights you need. What sets Tegus apart is its all-in-one platform. It's packed with expert call transcripts, management checks, panel calls, and in-depth financial data. No more jumping between different services or piecing together fragmented data. With Tegus, everything is right at your fingertips. The best part? The insights you get are from the very people shaping the industries you're interested in. You'll find perspective from insiders and executives that you can't get anywhere else. To see Tegus in action and understand why it's one of my go-to resources, visit tegus.com/value. That's TEGUS.com/value. Trust me, once you try Tegus, you'll never look back. Perfect. I want to give you guys an opportunity to wrap things up with anything I miss or anything, because it's not the easy. It's an easy story to understand, but as we talked about, you kind of need to get comfortable with, is this cost of capital business or is this good returns on capital business? But I want to wrap it up with one of my favorite subjects, and that's they've got an active stock buyback program. I think, under $1 billion market cap. They mentioned on the Q2 call, they said, hey, our share buyback program, NCIB up in Canada, is off to, they called it an active start. They're talking about $10 million a quarter. So obviously I'm lobbing you guys a softball question, but how do you look at kind of share repurchases and capital allocation on that side going forward?
Yeah, we like what they've done. It's been as they say, an all of the above approach. So they've put, a lot of capital into organic growth, which we generally see. Obviously, they have to deliver on it, but that usually has the highest returns if you have management you trust, and the lowest risk because it's businesses As Brian said, they put the hammer down late last year when they closed the sale, and the stock was a little bit lower than here, and they've consistently been buying back stock, and we think it's a good capital allocation. They believe in the growth. And they believe in the margin targets. So yeah, we're excited that they're doing that and have the balance sheet to look at acquisitions. What else would you add, Brian?
No, I think that's it. I mean, I think it's not very often that you see a company, put the hammer down aggressively on their buyback when the stock comes in. That's exactly what they did right on the heels of closing the pipe sale. The stock was a little bit heavy, and I think they exhausted their entire remaining buyback in like 6 weeks or something, which we love to see because they're just putting their money where their mouth is, and then they say, like, when the stock is 18, 20, it's they don't necessarily feel the need to be so unbelievably aggressive, but they're still buying back at kind of a measured pace. So yeah, we like their quote on all, what is it? All
of the above.
Yeah. All the above approach. They've got the ability to invest, in the growth of the business while also giving capital back to shareholders at really compelling multiples.
And they just refinanced their debt as well at a much better rate. Sorry, Andrew, go ahead.
No, I was just saying, I love to see that because Brian mentioned, hey, the stock goes weaker and they start buying back more. I'm sure you guys have seen it all the time. I normally see the reverse, right? The stock's higher and they're buying back shares. I'm like, this is pretty interesting. And then the stock's 50% lower. Like, we got to preserve cash. We've got debt coming due. The economy could get worse. Like, God damn it, they've done it to me again. But look, I think everything here was interesting. I will say the coolest thing I heard was that they were exercising stock options without net exercising. So they were coming out of their own pocket to pay for the stock options and cover tax costs and everything. Not that that's the craziest thing in the world, but I very rarely see it done. It's very, nobody really tracks that specific thing. But I will say in the past, when I've seen that, it has generally been a really good sign, because who's got a better view of value than insiders? Probably no one. And the fact in this case, it's almost like they're doing everything they can to maximize their upside exposure and align themselves. Guys, we have covered so much. I think we've done a really nice job of covering a story. Jason's the one who's been pinging me for 3 months. You've got to look at it. And when I finally started drilling down, I was like, oh, okay, I can kind of see the TerraVest rhymes. And, TerraVest is a 3X over the past year. So wouldn't be bad to have one of those. But I want to make sure, anything else you think we should have covered, listeners should be thinking about if they're interested in starting to due diligence story to kind of get ramped up on this?
No, I think we covered it pretty well. I mean, it's all about the organic growth and the magnitude of the investments they're making. If they're thinking as clearly as we think they are about their opportunities, these are going to be pretty powerful payoffs. And right now, you're in the middle of the no free cash flow. Oh, they're spending it all. People get sort of negative in those periods, and we've had some of our best investments where that's when you accumulate your position, because next comes the payoff, to all of that capital. So yeah, they got to execute. The bottom line is, they've had a couple little hiccups here. They need to execute better, but we think they're really, really quality people. We think they're thinking about the business the right way. And we love that they're buying back stock in the meantime while everyone's confused.
No, and I like how you put it there, especially I think small cap international, I do think there's less coverage and less people looking at it. And it's been, again, maybe this is more London, but it's just been beaten over my head like, hey, especially international with the dearth, you don't invest a year ahead of time when they're making the investment. What you really want is they've made the investment and the trailing numbers look terrible, but then hopefully they start to realize the fruits of that investment, and all of a sudden the market can really wake up when EBITDA goes from 50 to 150 because all of those investments start paying off and the stock, just looks, it looks really good and it's nice. The cash flow starts rolling in. These guys will buy back shares and everything. So cool. Jason, Brian, this has been great. Clayton Partners, you can actually, their website's really nicely designed. You can find it really fast if you just Google Clayton Partners, and you'll see some nice little photos of them under the team and everything. But look, guys, I appreciate you guys coming on, and I know there's one or two others that you guys are excited for. So looking forward to having you on for a second time.
Great. Thanks, Andrew.
Thanks a lot, Andrew.
A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.